Hello, Accounting 202 students. I hope you did well on your last exam. Today, we're going to be talking about Chapter 23. So last chapter, Chapter 22, we had created budgets, right? So again, that's management's plan, right? Plan of attack. So we're here and we want to be there, okay? And this is how we're going to do it. And so last chapter, if you remember, we wanted to get everybody involved in setting up that budget. Well, now it's time, right, to either use direction or correction as we look at those a little bit closer. All right, and so this chapter is all about variances. Okay? And as you'll see in a moment, variances are just the difference between what we thought was going to happen, the budget, right, to what actually happened, right, real life. And why, right, why is there a difference, right? And so if you remember, I mentioned this way back when we started talking about managerial accounting. I said, one of the best questions a manager can ask is the question, why, right? And so I'm going to take my video off and I'm going to put together a PowerPoint, or we're going to use the PowerPoint provided by the textbook company. The reason being is that there are so many numbers that carry through, and I just want you to be able to see those in a organized manner. All right, and so for now, I will say visually goodbye, and I will share with you this PowerPoint. So hang on a second. And so as I said, chapter 23, let me do this. Okay. Chapter 23, actually, let me go down. I think it's better the other way. All right, so I can still write on this. Yeah, I can still write on this. And so let me just make sure that that is still up. All right, so I'm going to take it down and share it again just to make sure that it's all there. All right, so yeah, we're here. And let me see if I can increase the size a little bit. All right, and so chapter 23, evaluating variances from standard costs. All right. And so moving down, all right, standards, okay, what are standards? Right, they're performance goals, all right, and so hopefully you remember from budgets, right, and because I tried to highlight them, I said, hey, that's a standard, isn't it? So when we had the direct materials budget, if you remember, we had to purchase a certain amount of direct materials in order to produce the number of budgeted units, right? So sales drove production, production drove the direct materials purchasing budget. Right? And I did highlight several standards, okay, that were used in our budgeting process. For example, a standard revenue, okay, selling price, that goes all the way back to our chapter on break-even analysis, right? So standards are just performance goals. Again, we want to use the most accurate standards that we can. Right? And so when it comes to a manufacturing company, if you remember, we have our three costs, right? We have our direct materials, direct labor, and factory overhead. And so with those, we're going to utilize standards so that we know if we deviate from those standards, something must be up, right? And that's where we're going to ask ourselves, what's going on, or why is this happening? And so an accounting system that uses standards for product costs is called a standard cost system, all right? And again, if we don't utilize the budgets, then we don't have anything to base our actual results against, right? And so when actual costs are compared with standard costs, these exceptions or variances, as they're called in this chapter, are reported. This reporting by the principle of exception allows management to focus on correcting the cost variances. All right, and so this idea of management by exception basically says, hey, if it ain't broke, don't fix it, right? So if we're chugging along and our costs are in agreement to what we thought they were, okay, then there's really no deviation why look into it, right? Okay, or why micromanage, right? However, okay, when there are deviations, that's when we're actually going to look into things. Right? And so when setting standards, right, normally we require the joint efforts of accountants, engineers, and other management personnel, right? Sound familiar? Yeah, this is the same thing that we talked about when we were coming up with our budgets. Accountants can't do this on their own, right? The accountant is probably the one that's going to accumulate all of this stuff, all right, and translate it into dollars and cents, okay? But we definitely going to need to have, purchasing, production, HR, okay, and all the different specialties, all right, in our organization. So when we're trying to come up with a standard, all right, you need to understand that there are different levels of standards, all right? And so there's this thing called an ideal standard, all right, or a theoretical standard, okay? These, all right, are as it says, just theoretical, all right? And so I think I might have in the past used the example of, hey, how many students, all right, could we have at Southwestern Michigan College, okay, during one semester? Well, theoretically, okay, our classes are 2 hours long, okay? So we could have 12 classes a day in a 24-hour time period, okay? We could have 7 days a week, all right? And how many of our weeks, all right, are in the year, okay? We could actually figure out, okay, theoretically, how many accounting students we could push through our program. Count up the chairs, right? Because the chair, one person, right? And we multiply that times 12, right? 12 classes a day, okay? And we could theoretically find out how many students we could have one semester. But that's unrealistic, right? I mean, nobody, especially myself, are going to be coming to class, right, at 2 a.m., right? Okay. And as you realize, okay, all the seats in our classroom are not filled. And so, that would be an ideal standard. Ideal standards are important or useful, because if we had to run, right, right, a limited time, we could theoretically, right, push X number of students through our system, right? Okay. However, right, normally we back off from theoretical capacity, right, to more attainable standards, right? Sometimes they're referred to as normal standards, okay? And this takes into account that, yeah, nobody is going to come to class, all right, after 6 p.m. So we might have a class that starts at 6, but nobody's going to come after that. I mean, the college closes down, right? Nobody definitely is going to be coming in the middle of the night, right? So we're going to back that off, right, for more realistic things, right? And again, these are what are referred to as normal standards, okay? Such standards are used by most companies. They allow for normal production or demand, all right? When reasonable standards are used, employees focus more on cost and are more likely to put forth their best effort. See, when we're talking about the setting of standards, all right, we're going to utilize these normal standards. And so reviewing and revising standards, all right, these are not stagnant, all right? They don't stay the same, all right, period after period. We need to go ahead and revise these, all right? And so, just because, all right, we exceed a standard, right, doesn't mean that standard is wrong, okay? So, let's say that, it's proven that in order to make a board short, it takes about 45 minutes to cut the material to make those board shorts. Just because nobody can do it, all right, or I should say, just because Bob can't do it, right, doesn't mean that that standard is wrong. It just means Bob is not very good at cutting material, right? And so maybe we need to replace Bob. And so, standards, right, can be accurate even though they might not be being met. Right? However, just because the standards are being met doesn't mean that that can't be improved either, right? So standards should be revised, okay, when prices, product designs, labor rates, or manufacturing methods change. Some criticisms of using standard costs for performance evaluation include, right, standards limited, they limit operating improvements, all right, because again, if it ain't broke, why fix it? Right? Standards can be too difficult to maintain, right, in a dynamic manufacturing environment, okay? So the prices are changing so frequently that we really can't lock into a standard price. Standards can cause employees to lose sight of larger objectives, right, and which could ultimately impact the company as a whole. Remember, we talked about that when we talked about budgets. We called that goal conflict, right? And standards can cause employees to unduly focus, right, on their own operations, right? And again, that's the idea of goal conflicts. And so budgetary performance evaluation. Okay. We created our budget last period. Okay, so budgets are created at the beginning of the period. And this chapter really looks at using those budgets either during the period that was budgeted or at the end of that budgeting period. All right, so let's just say we're looking ahead for 2021, and we formulate a budget. 2 months into 2021, we might want to do some comparisons. We want to see how are we actually doing against what we thought we were doing. And so, this concept is not new, and we talked about it a little bit before. If we are spending too much time, okay, we would be over budget, right? Or if we were spending more money, we would be over budget. And so that's kind of the idea that we're going to be talking about when we talk about variances. Okay. And so we're going to use this company called Western Ryder, right? And they manufacture blue jeans. Okay. And they do use a standard cost system in creating its budgets. Right? So the standard for direct materials, direct labor, and factory overhead are separated into the following two components. Right? There's the standard price, okay, of input, and the standard quantity, right, of input. Right. See, if you struggle with this chapter, generally people struggle with inputs versus outputs. Okay, and so in this case, all right, Western Ryder are creating blue jeans. Okay, and this is output. Okay, and so when we're talking about direct materials, okay, those are the inputs, okay, for those outputs. Hopefully that makes sense, right? And so a standard cost per unit for direct materials, direct labor, and factory overhead is computed as such, right? The standard cost per unit equals the standard price, right, times the number of units, right, or standard input units. And so here, all right, are our standards. Now, if you can find this in your textbook or whatever, this is actually, really our guide to our standards, all right? And so we have our direct materials, direct labor, and factory overhead, okay? And so I'm writing this down so that I don't have to keep flipping back and forth, all right? And so we have the standard price, right, for our direct material, okay? So who do you think comes up with that standard price of $5 per yard? Who do you think comes up with that? I'm betting, all right, that purchasing comes up with that, all right? And so in this case, we're looking for material, all right? And I bet purchasing, calls its suppliers and just say, hey, do you guys anticipate any price increases in the next year, all right, or in this budgeted time period? And they say, yeah, we're going to probably increase it to $5 per yard. And so it's probably purchasing, because we're going to talk about this, when we talk about responsibility centers, right? Who is responsible for deviations in the price of our materials? Well, that's our purchasing department. Okay. Who would be responsible for, the direct labor? Okay. So we had that $9, okay, per hour for direct labor. Yeah, that's right. HR, human resources, are the ones that, so they're taking into account any any increases in minimum wage and whatnot, the supply and demand of labor, so it's HR that's probably coming up, right, with that $9. And then we have factory overhead. Factory overhead is $6 per hour. So can you remember chapter 2021, when we're allocating factory overhead, all right? And we said, hey, one of the things we want to be able to do is identify a cost driver. Okay. Well, can anybody identify the cost driver here? Yes, it's direct labor hours, right? Because as you'll see in the next component, all right, where we have the standard quantity per unit, right? So that standard quantity per unit, okay, this is input units, okay? That's input units. And so who do you think we're going to call, all right, to find out how much square yardage we use? Yeah, that's probably production, isn't it? Okay. So standard quantity, okay, they're saying, hey, you know what, to make a pair of jeans, okay, it takes 1.5 yards, okay, of material, all right, to make one pair of jeans. It takes 80% of an hour, okay, in order to make a pair of jeans. And this is why we know that the cost driver is direct labor hours. It's the same per hour unit, right? Or 80% of an hour, all right, in order for the factory overhead. And so again, probably production, all right, they're giving us all this information, all right? How much yardage are they using? How much time we're going to use, right? And so it works out, okay, that our cost per input, right, of direct materials is going to be $7.50. Okay. We have direct labor cost, right, $7.20, and then $4.80. That gives us a standard of $19.50 cost of input, right, per unit. So it's kind of interesting is, as you probably know, I work for Faith Riding Company, which T-shirt, but we also made board shorts. Okay? And we actually had a standard. When we ordered material to make board shorts, okay, we had a 1-for-1. So if we were going to make 3,000 pairs of board shorts, we would order 3,000 yards of material. Okay? Because, with board shorts, and just so you know, they're called baggies, all right? So they went down to your knees, all right? This, 1.5 yards to make a pair of jeans, that's pretty close, all right? Because if you think about, board shorts, at least the ones we were making, it was actually 1 yard of material made one board short on average. And, it's roughly about another half a yard, right, to go from the knees to the ankles, right, to make pants instead of board shorts. So it's kind of interesting that this is pretty close, all right, as far as the standard input, right, for making jeans or pants. But the point here, all right, is that we've created some standards. We have two types of standards. We have the price and we have the quantity. And we're going to be using these, right, to make comparisons. And so with a budgetary performance evaluation, okay, again, we use that master budget. It's prepared based on planning of sales and production. Right? The budgeted cost for materials, purchases, direct labor, and factory overhead. All right, we came up with all that information on our budget, and so we use budgeted or standard cost. All right, when we created that stuff, and so now, all right, we're going into the year. All right, and so I want to first of all say, hey, if we use these standards, okay, as soon as we deviate from the standard, we have the ability to control that. Right? So if you remember going back to the roles of management, so, there's planning, there's directing and controlling. All right. And so, if we can catch a deviation early, we can fix it hopefully. Right. And so, that's the benefit of one of the benefits of using standard costs. And so budget performance report, right? The difference between the actual and standards, okay, it's referred to as variance. A favorable variance would be under budget, All right, so when you think about, performing under budget, okay, that would be favorable. That's a good thing. And if you think about management's perspective, they're like, yeah, if we're under budget, we're going to be making more money, aren't we? Whereas if we're over budget, well, that's not good. Okay, that's unfavorable. And so really, when we talk about the calculation of these things, we are talking about favorable and unfavorable variances. FYI, I just want you to know that the final exam, okay, is only multiple choice. And so I really want you guys to be focusing, all right, on these last chapters, on how this type of questions could be asked in a multiple choice format. No longer are we going to have problems, all right? They're just going to be multiple choice format. So the report that summarizes actual costs and standard costs, all right, is called the Budget Performance Report. The Budget Performance Report is based on actual production rather than planned production, all right? And so really what they're talking about here, all right, is the difference between a static budget and a flexible budget, all right? And so, we're going to use the actual production, right, versus, all right, what was planned. Now the planned, okay, is our budget, right? And, we're actually going to compare the budget, the planned stuff, against what actually happened. And so, all right, here's the information that was provided for us for Western Rider, all right? They, okay, produced 5,000 pairs of jeans. Okay? And so hopefully, all right, you can realize that this, all right, is our output. Okay, we're producing 5,000 pairs of jeans. And so we're going to adjust all of our budgets, all right, to the 5,000 units. This really isn't a big deal when we're talking about direct materials and direct labor, okay? But this is going to be kind of huge when we talk about factory overhead, right? Because if you remember, direct materials and direct labor are variable in nature, and so are sales units, aren't they? And so this is going to be key. These are our output units. Okay? When we do our comparisons, we're going to compare per the input units, not the output units. Okay? But here's the information, all right? And so, we will actually compare those numbers, right, to our actual costs. And so if you think about it, all right, if you, again, I wrote this down, thankfully, all right? If we produced 5,000 pairs of jeans, right, and those jeans, as far as direct materials, we had budgeted those at $7.50, right? So if we take the 5,000, right, and multiply that times $7.50, okay, that's how we come up, right, with this 37,500. So again, for direct materials, we took 5,000 pairs of jeans, multiplied times the input cost, right, of $7.50. And that's how we came up with that. Okay. And we're going to do the same thing for the labor, but in this case, labor was $7.20. Okay. And we're going to come up with our factory overhead. Oh, hey, it's down here. I didn't even see it. Okay. Those calculations are down there. And so we can see that, hey, we thought to make 5,000 pairs of jeans, we thought we were going to have $37,500, but we actually incurred $40,150. Okay, that is unfavorable, isn't it? Because it's over budget. Right? This is unfavorable. Again, we compare what we thought was going to happen, the standard cost, right, against the actual cost, and our direct labor was also over budget or unfavorable. But when we look at the factory overhead, we're like, hey, we thought we were going to spend $24,000 to make 5,000 pairs of jeans, but we only spent $22,400. That's favorable, isn't it? And so, looking at this budget performance report, it tells you something, right? It tells you that you're over or under budget, that, hey, we did great with factory overhead, but we kind of lost it, right? When we looked at the direct materials and direct labor, because overall, okay, we were over budget or unfavorable by 3,550. Right? So just so you know, this is unfavorable. Okay. This is favorable, not under or over. That the U stands for unfavorable. And so total manufacturing cost variance is the difference between the total standard, right, and the total actual. Right, that's what we looked at before. But that really, it just tells you, but it doesn't really help you to control, all right? For control purposes, we need more information, okay? And so what we're gonna do is for each one of those direct materials, direct labor, and factory overhead, we're gonna break them into smaller variances. And so the total direct material variance is separated into price and quantity variance. This is because the standard and actual direct material costs are computed as follows. So the actual direct material cost equals the actual price, right? And again, we don't have that information yet, times the actual quantity, and the standard price versus the standard quantity, right? When it comes to direct materials, we had that, right? We had the standard price was $5, right? And our standard quantity, right, was 1.5 yards. Right? Okay. Thus, the actual and standard direct material costs, right, differ. It could be difference because of a price, right, or a quantity difference. Now, I want you to know that this quantity difference, okay, really is an efficiency variance. Okay, so outside of this textbook, I want you to know that most textbooks refer to that as an efficiency variance, not necessarily a quantity variance. Well, we do the same thing, all right, with labor, okay, and again, they refer to this as a time, okay, time and well, I'm sorry, yeah, it's a time and a rate variance. A rate variance. Okay. Again, know that this, outside of this, outside of this textbook, right, this is still price and efficiency. Okay. So outside of this textbook, it's price and efficiency. But going up here, the standards, we know the standards, all right? The standard direct labor, okay, is $9 per hour, all right? And the standard time is 80% of an hour. We just aren't given these things yet. And so the total factory overhead variance is separated into controllable, all right, and volume variance. Okay. This probably is the hardest part of this chapter, right? Because as you'll see, the calculations really aren't that difficult, all right? But conceptually, this one is a little bit different. And so what we're able to do, right, is we're able to take the total manufacturing cost variance. That's the difference between, the total budgeted cost and the total actual costs, right? And we'll break it into the three components: the direct materials cost variance, the direct labor cost variance, and the factory overhead cost variance. But then we can further break these down, right, into the direct material price, quantity, okay, the direct labor rate and time, okay, and then this one is controllable, and this one is volume, right? And so I'll point this out later. This is for the variable factory overhead, and this is for the fixed factory overhead. So direct materials and direct labor variances. As mentioned previously, the total direct materials and direct labor variances are separated into direct materials cost and direct materials cost and direct labor cost variances, and then further broken down into their price and quantity, right? Or price and efficiency, and rate and time, or price and efficiency. So these, as you'll see, the calculation of these things, right, are done the exact same way, all right? Price and efficiency. And so during June, Western Rider, so we're looking here, I'm highlighting, we're looking at the direct materials variance. And with the direct materials variance, we're given the actual costs. Okay? We're given the actual costs. Okay? Those actual costs consist of, all right, $550 per square yard and 7,300 square yards. So that's how we came up with this. Right? If you remember, okay, our standards, okay, were $5 and 7,500. And so we're going to go ahead and I'm going to show you how to do, all right, this using, using a 3-column methodology, all right? And so in this method, and the textbook does talk about this, but they, I don't think they take very much time to describe that, all right? And so really what we're going to be looking at, all right, we know that we are producing 5,000 pairs of jeans, all right? Okay, so these 5,000 pairs of jeans, this is our output, right? Okay, and so this is going to be broken into, all right, the variances between what we thought, okay, or the budget, okay, to what actually happened. And so when we are calculating the budget, or what we thought was going to happen, right, we calculate the standard price times the standard quantity, right, of direct materials. Okay, and so the standard quantity, really what we're going to do is we're going to say, hey, because we're using a flexible budget, we're going to use this 5,000 pairs of jeans, okay, and we had budgeted that we're going to take us 1.5 yards. Okay, we end up with 7,500 yards, okay, of materials. We multiply that times the $5, okay, per square yard, and we end up with the number that was provided there, the 5 times 7,500. Okay. That gives us the 37,500. Because if you remember at the top layer, all right, we are basically saying that, hey, we're comparing this to what actually happened, okay? And this is what's referred to as our direct material cost variance. Okay, this is the overall difference. All right, so in our last, they said that we had actual costs of this 40,150. So 40,150. Okay, and so we're trying to explain, okay, what actually happened here, okay, to what we thought happened over here. And so this difference is, it was on that that first budget, right? We basically had a 2,650, right, unfavorable variance, right? Because this was, over budget by 2,650. Okay? That explained, right, the difference between what actually happened versus what we thought was happening. Well, this 40,150 is broken up into, all right, the actual price times the actual quantity. Right? And if you remember, this was the previous slide, okay, it said that our actual price, okay, was this 550, right, and our actual quantity was this 7,300. And so if we took our actual price of $5.50 times our actual quantity, right, which was 7,300 yards. See, they already did the calculation. They already calculated. This was 5,000, so if we took actually 7,000 300, okay, and we divide that by 5,000 genes that we made, okay, our actual quantity consisted of $1.40, or I'm sorry, not a dollar, a 1 yard 46, right, times 5,000 yards. Right? They don't actually give you this information here, okay, but that's how they came up with the 7,300 yards. And so, as we said, this gives us useful information, right? It's saying, hey, we're over budget when it comes to our direct materials. But if we wanted to know why we're over budget, okay, we're going to have to come up with a center column, right? And so the center column is going to consist of, right, the standard price, okay, and the actual quantity. Right? See, what we're trying to calculate is we're trying to calculate, right, the price variance. Why are we off because of price, right? And so if you understand algebra, if you want to see the difference, right, of two components, right, you're in essence, you're just looking at the difference between the actual price and the standard price. The actual price and the standard price. You've kept the actual quantity the same. Right? And so that's what we're going to do is we're going to bring over the standard price here, $5, okay, and we're going to multiply that times the actual quantity of 7,300 yards. And so our center column, 5 times 7,300, is just looking at the difference in price. And so we ended up with 36,500. I just extended those things. And so when we look at the difference between this, I should put this down there, hang on. Okay. When we put the 36,500 here, okay, we see, okay, that when it comes to price, okay, that's unfavorable. It's unfavorable because we can look, hey, you know, we actually spent $5.50, right? When we only budgeted $5. That's 50 cents per pair of jeans, right, over budget. Okay? Or the difference between this number and this number. Okay? And so just look at the difference. That comes out to be a 3,650, right, unfavorable variance. Why? Because of price. So who do we talk to when it comes to price? Well, we call up our purchasing agent and say, hey, what's going on, man? All right, we thought that it was only going to cost us $5 per yard, right, for this material. What's happening, right? And you know, it's important to understand what would be good rationale. All right, you know, he could just say, hey, you know what? You know, the numbers that they gave me at the beginning of the year, they're just flat out wrong. All right. Or, okay, he might say, well, I talked to production, and production asked if I could get the more expensive, you know, quality fabric. You know, because again, you know, the input makes a difference in the quality of the output, right? And so if that's the case, what are we going to do? We're going to fire him, aren't we? Right? Because we're going to say, hey, you know what? Yeah, there is a benefit to, you know, the quality, but you can see that we are over budget, okay, by 3,650. So let's go now and look, all right, at the difference between the quantities. All right, so what we're doing is we're comparing this quantity and this quantity. We're holding the standard price, right, the same. Okay. And so really what we're doing is we're looking at the quantity variance. Okay. And we can see that, hey, this is $1,000, okay, favorable, isn't it? See, we thought as far as quantity, okay, we thought that we were going to spend, or use, I should say, not spend, 7,500 yards, okay, but we only used 7,300. Why? Well, maybe because if we have a higher quality input, all right, we're more efficient, aren't we? But you can see that we lost, okay, because of the decision, right, that purchasing made, maybe because they were forced, okay, by production or production, all right, because production, what they want to have high quality output, okay, where the pressure on purchasing is low cost, right? Well, for some reason, purchasing listened to production, right? But they didn't listen to top management. Management said, hey, you know what? We want to have the middle of the road input of material, okay? But it's going to cost us, I mean, if our standards held true, okay? It would only cost us $5 because we, in essence, yeah, it benefited us because we had a $1,000 favorable quantity or efficiency variance. Okay. But offsetting these two, okay, these two resulted in this number there. Okay. We still lost money. All right. We don't want to lose money. Now, granted, if it was something else, right, that was unrelated, right, to the higher quality, they did obey or whatever. It just maybe we should reward production, so maybe it was just a price increase, right? $5 or a 50-cent price increase. Nothing we could do about that, right? But if that was the case, then we probably want to go ahead and reward production because with the same product, they were actually able to be more efficient with what they had. Does that make sense? I hope so. And so here's an overall picture, right? The same calculations, probably a little cleaner, right? But I think it's important for you to be able to see that relationship. And so I'm going to stop here. I'm going to break this up into multiple units or parts for easier digestible process. Know that the direct labor variances is for the most part, right, the same process that we did for the direct materials. So I'll end it here and I'll see you on the next recording.